Hi everyone and welcome to our market update for August 2016. I'm here with Rob Gilmour. I'm Aaron Upcroft. Rob, the RBA decision today, tell us a bit about it.
Yeah, thanks Aaron. We've got a new record low in interest rates, so 1.5%. The RBA decided to cut today in what was a widely predicted move.
It seems like there are always new lows at the moment. It's the kind of it's where we're at in the market, right? And this one was widely predicted. We knew it was coming as well. We spoke about it last month. Just take us underneath a little bit. Tell us about it.
Yeah, look, at the end of the day, the inflation numbers came out quite low. That gives the Reserve Bank comfort to cut rates. They're worried about a high exchange rate, so a lower interest rates can help sort of dampen the Aussie dollar a bit. There's also some caution there around the Australian economy. They want low rates. They want business to start investing, so businesses can start to stimulate jobs and growth. Overall, the RBA sort of feels that they had some comfort to cut because they see the rise in house prices slowing, and they see lenders being a little bit more cautious. But that's pretty difficult to fathom. And I don't know, what are you seeing in terms of your side of things for credit and lenders in the housing market?
Yeah, housing's interesting. It's winter, so during winter times there's not a lot of stock on the market, so there's always people willing to buy and willing to spend. And when credit markets are like this, people have the affordability, and a cut like this means they've got more affordability, so it means they're even more willing to spend, and it means they're stretching. And in general, people like to stretch to buy that family home, and when they're upgrading especially. So we're seeing more and more of that, and this will only fuel that, I think. So to see that people will think that they can stretch just that little bit more, and with low stock on the market being winter, it means that it's a tough proposition when you're out there in the market, because people are ready to go that little bit more.
Yeah.
So that's that. And from a credit point of view, well, CBA only cut 13 points out of the 25. They've already led the way on that.
So the banks are keeping a little bit of it, and that doesn't surprise me. Their margins are being squeezed. They have to hold more capital. They're worried about their profitability. So that doesn't surprise me.
Not surprising at all. And quite interestingly, ING dropped about 2 weeks ago, 15 points, outside of any cycle. And I think they just did it to grab a bit of market share. So it'll be interesting to see what the ING do, for instance, in this round. But it wouldn't surprise me if there's only a part-way cut. But even still, like with rates where they are, it means credit's still lower, affordability's higher.
People are stretching
further, and it's still going to help fuel where we sit. And when the spring-summer season starts to come, the properties come back on the market, and I think it'll still be very buoyant then.
Yeah, which is a dangerous part of the cycle in my view, considering what it's done in the last 4 years.
Yeah, absolutely. And I mean, what about all your other clients within other investments outside of housing?
Obviously there's a lot of people cheering for lower interest rates if they're mortgage holders. The flip side, for people who are self-funded retirees, it's a real challenge to generate income in a low interest rate environment. With low interest rates, they are being forced to move their assets into the sort of more riskier end of the spectrum. It's a product of what's going on around the world. Interest rates are very low. We live in very tumultuous times. Yeah. We're seeing shootings in the United States. We're seeing terrorism in Europe with the horrible act of terrorism in Nice, a coup in Turkey. And we've got a presidential election coming up in the US, with potential President Trump. It's very tumultuous times, but stock markets around the world have been doing very, very well, and that's because the central banks are turning the money taps on. They've been doing it in response to Brexit. Right. The Reserve Bank feels the need to follow suit. The US market, it's hitting all-time highs. The Australian market, has 12 month highs recently. Though today it dropped. It was a bit of a buy the rumour, sell the fact with the rate cut. Right. But my point is there are risky times. There's a lot going on. Markets are being buoyed by these low interest rates. And so what we do here is, we're not only sort of paid to sort of provide retirement incomes and make money for clients. It's also about protecting capital. And these types make those kind of investment decisions very, very important. And frankly, it is a time to be cautious and not just cheering low interest rates.
Yeah, agreed on my side. And look, that's our market update for August 2016. We'll see you again next month.